Hi, I'd like to welcome you to Kaplan's webinar on 4 tax tips that every realtor should be aware of. In fact, let me say this. These 4 tax tips apply to any business that anyone's in, whether it's contracting, whether it's speaking, whether it's advertising, whatever. These are just 4 really good tax tips that I want you all to be aware of. Now, my name is Chris Bird, and I do a lot of instruction. I spend about 130 days a year on the road. I teach a lot of classes for Kaplan, and if you're interested in taking anything that I do with Kaplan, please check Kaplan's website. And my content is very rich. There's a lot I need to talk about. If I have time to take questions today, at the end of this, I will, but I cannot guarantee that I'm going to have time for questions. We'll see how our time comes in. Now, a little bit about my background. I've been doing this for over 30 years. I started right out of college as an IRS agent. In fact, I was trained in Minneapolis, Minnesota for the first year and a half. I do spend about 130 days on the road speaking on tax and financial planning matters. I'm a certified financial planner. I am a licensed Illinois real estate broker, but my passion is speaking. So I want you to enjoy this, and I want you to take this material from a conceptual standpoint, and don't get into the trenches with it, but just get out of it what you can so you can talk to your accountants about this. Now, first and foremost, you are not here to become accountants. But if you learn something that you think is interesting and you think is relevant to your tax situation, please take my material to your accountant, have a discussion with them. Also, please start using programs like Quicken or QuickBooks or Mint.com for the younger audience. Mint.com in the cloud, I think it's basically free, and it just really does almost what Quicken does. I personally use Quicken, but all of these are good programs. Talk to your accountant about what they might want you to use. Now, I have 4 points I want to talk to you about today. And the first one is, get your records organized. So if you're using the same accountant that you used in 2013, I want you to contact the accountant, have them prepare you an organizer for your 14 tax return. And what that organizer will have, it'll have basically all the information line by line and the amounts that appeared on your 2013 return on the 14 organizer, so that you don't forget anything that you claimed last year. It'll also have a lot of questions that your accountants are going to want to ask you during the interview to have the return done. But above all, please don't get in the habit of just dropping your material off to your accountant and then picking it up a couple of weeks later. You're just not getting the full service of your accountant. You need to talk to them. You need to ask them questions. And part of this webinar is arming you with the right questions to ask your accountant about. Now, the second point I want to talk to you about, and this may sound like Boy Scout, but this comes from the heart. Do not play around with your tax return. Your income is taxable. All your income should be reported on the return. Aggressively but legally claim your tax deductions. If something is personal, it shouldn't be on your return. But if it is arguable that it could be a business expense, then you should be talking to your accountant about it. And let me tell you a quick story. I was contacted last summer by a very successful real estate agent that's been in my seminars over the years. And she was almost crying on the phone when she called me. And I don't do her tax returns. In fact, I don't do tax returns for a living anymore. And she was under audit by the IRS, and she was literally scared of the audit. And I asked her, I said, well, did you report all your income? And she goes, absolutely. And realtors, you know, you get a 1099-R from your sponsoring, 1099 miscellaneous, excuse me, from your broker, and that's your income for most of you. But what she had done, and she admitted to me, is she overstated deliberately a number of deductions, and honestly, by over $150,000. So I told her to basically tell her accountant about this, and I hope all goes well for her in the audit. But I ask you, please, your ethical realtors, be ethical in your tax filings, and then you don't have to look over your shoulder and you can sleep at night. Now, The next point, and this is where I'm going to spend most of my time in this webinar. Check and double check that you're not missing legitimate deductions. And I'll give you an example. One common question that I get in doing these webinars and whenever I speak is, if I file on extension, will that basically reduce my chance of being audited by the IRS? And while the IRS will never admit that, I will tell you that in the practitioner field, in the tax professional field, that kind of is a general consensus that if you file by the October 15th deadline for your 1040 or by your September 15th deadline for your corporation, it may reduce your chance of being audited. Another common question that I get is, if I have a loss in my first year of being a realtor, can I claim it? And the answer is, if you were really trying and it wasn't a hobby and you were really trying to make money in real estate, the answer is yes, you can. So don't let an overly conservative accountant talk you out of this. Now, what are some of the other deductions that I need to talk about? And again, this is where I'm going to spend most of my time in this webinar. Your vehicle is probably one of the most significant tax deductions you can take every year. So first, let me talk to you about the standard mileage rate. In 2014, the return you're doing for last year, the standard mileage rate was 56 cents a mile. In December of 2014, the IRS announced for 2015 that the number would be 57.5 cents a mile. But a lot of accountants miss something. If you claim the standard mileage rate, which I recommend most of you to do, all right, then in addition to the standard mileage rate, you are entitled to take any business parking and tolls that you incur, plus any interest on the car loan. The business percentage of the interest on the car loan is deductible in addition to the standard mileage rate if you are self-employed like you are. Don't miss these deductions. One more thing. Standard mileage rate means less record keeping. Take a look at the next slide. If, on the other hand, though, you claim the actual expenses, then take a look at the paragraph on the slide. Then you're going to be able to deduct expenses like washes, waxes, gas, oil, repairs, maintenance, insurance, interest on the loan, just like you were on their standard mileage rate, and one other word, depreciation. So put that word depreciation in your mind, because I'm going to take you through a number of slides to show you what that depreciation deduction is all about. But before I do that, take a look at the numbers on the slide. No one should be taking 100% business use of the vehicle. It's a red flag, all right? I typically use anywhere from 88 to 92% of my vehicle for business every year. It changes every year. It's never the same amount, and it's just never 100%. I guarantee it. So in my example, let's say you put 24,000 miles on the vehicle for the whole year based on automobile oil change receipts, where they have to, by law, put the mileage on the receipt. You put 24,000 miles on the car. And by keeping records for at least 3 months of the year under the sampling technique recommended in IRS Publication 463, IRS Publication 463, only requires you to keep detailed records of your business use of the vehicle for 3 months of the year, all right? And that is what I would recommend at a minimum that you do. So in that 3 months, you came up with 4,500 miles times 4 is 18,000, and then you would get 75% of all the expenses listed in the next paragraph. Now, what I want to focus on for the next 4 or 5 slides is what you can depreciate if you're claiming the actual expenses. So, first, if you buy a used car, not an SUV, not a pickup truck, but a used car, and you use it 100% for business, hypothetically, the most you can depreciate is $3,160 in the first year. But if you buy a brand spanking new vehicle, brand spanking new, that's not in the code, but it's never been owned, it's never been titled, the tax law gives you another $8,000 on top of that. And that's all about putting people to work building the vehicles. If you buy used, then that car was built several years ago. You buy new, it's been built in the relatively recent past. So the point is, cars are $31,660 if purchased used and $11,160 if purchased new. And remember, you're not claiming the standard mileage rate on this vehicle. And also remember that in addition to these numbers, that you're also able to claim the applicable percentage of your gas, oil, operating expenses, insurance, interest on the loan, etc. But then take a look at the next point on the slide. The big deductions come with the heavy SUV. That is a vehicle, an SUV, a sport utility vehicle with a gross vehicle weight rating in excess of 6,000 pounds, which you will find on the production sticker, the production plate, on the driver's side door jamb or hinge side of the door. It's there, all right? And there's even a larger deduction if it is a used or new pickup truck, and I'm going to show you all the numbers here. Now, one thing I'd like to say, please don't make the mistake of being penny wise and pound foolish. Don't be looking for big deductions from these larger vehicles if this is just not what you are, all right? But if you are in need of a vehicle, then there's some consideration that should be given to some of these things. Now, take a look at this. First of all, here's an example of the SUV. And I'm not sure what kind of vehicle this is, some kind of Ford product, but remember this. Everything I'm going to teach you now has to do with vehicles purchased prior to 1/1/15. So I'm teaching you the law for your 2014 return. I firmly believe that what I teach you now will also be extended through the end of 2015, but nobody can guarantee that that's going to happen. I believe it will. And as an example, only on December 19th of 2014 were these deductions that I'm showing you on the slides on the heavy SUV and the pickup truck allowable through the end of 14, so we had to almost wait the entire year before we found out it was going to go. Now, take a look specifically at the Cadillac Escalade that I have on the slide in front of you. Now, this vehicle is brand new. It costs $65,000, and assume with me that you're using the vehicle 90% for business. 90% times 65 is $59,500. And the way the deduction is calculated, remember, you're not here to become accountants, but the way the deduction is calculated, you end up with a $45,700 deduction the first year. Whether you've made a payment on it or not, the first year deduction is $45,700, which I guarantee that you will probably save anywhere from $15,000 to $18,000 in taxes the first year. Now, one more comment. If you're in your first year or so of real estate, everyone, and you're building up your business, maybe this is not what you want to do. But for those of you that are real successful in your business, that need a new vehicle, and you're making a lot of money, and this is the kind of vehicle that you would like to drive, this is the deduction. Now, for those of you that may be a little bit more math-oriented, if you look at the slide, here's the way the calculation goes, all right? And again, you're not here to become accountants, but it's a combination of the 179 deduction, bonus depreciation, and regular depreciation. Every figure in red ends up being part of the deduction, which totals $45,700. This slide backs up the picture slide that I showed you previously. So now the question is, what if you buy this same vehicle used, but obviously if you're going to pay the same price for it, then this is a more fully loaded Cadillac Escalade, for example, than the one I had before. All I want to show you is this. You buy it used, the deduction is not quite as good. It's now $31,900. So I leave it at that, everybody, other than to show you the pickup truck. Now take a look at this slide. If you buy it new or used, right, and let's say you pay $55,000 for this pickup truck, The first year deduction is $49,500, new or used, as long as this full-size pickup truck has a bed length of at least 6 feet. So not only has it got to have a gross vehicle weight rating over 6,000 pounds, which they do, all right, it's got to have a bed length of at least 6 feet. All right, very good. Now, what about other things? Let's get away from vehicles for just a minute. Let's say that you go out and buy a computer, a laptop, a desk model, desk furniture, things like this. You have a choice between claiming the $179 deduction or depreciating those items over basically 5 or 7 years. So it's something to talk to your accountant about. Moving into other deductions, and I want to hit this very quickly. Realtors and any self-employed person listening to this webinar, looking at this webinar, how are you going to retire? So what you've got to think about is SEP IRAs, 401ks, things like this. And I don't want to make a study out of this. I more or less just want to make you aware of this. But there are things like SEP IRAs and 401ks that allow you to put money away for retirement and take a significant tax deduction for doing just that. So the slide talks about the 401k, all right? But take a look at the slide I have up now, which references the 2014 and the 2015 year. And look at the 401k column, if you would. In 14, you can put in $17,500. In 15, you can put away $18,000. And with a SEP IRA, it's $52,000 and $53,000 respectively. So food for thought. Now watch this, all right? If you want to really put some money away, study this chart with me for just a minute. To grab as many of you as I can in this calculation, I've got 3 charts, 50,000, 80,000, 220, 3 columns. And if you have a SEP IRA, look at the bottom row. You can put in those amounts in the bottom row. But go 2 rows above where it says equals the 401k. All I want you to look at is you can put more money away with a 401k than the equivalent SEP IRA. So that's all I want you to look at. Talk to your accountants about this and see what happens. All right? Now, if you are 50 years of age or older, right, and you use something other than a SEP IRA, like the 401k, you are allowed to put in more money. And I kiddingly refer to this as the geezer rule, and I can point to myself because I am 50 years of age or older as well. But if you have a 401k or an IRA or a simple, all right, take a look at the slide. Last year, for last year, which you can still do now, all right, you are allowed to put an extra $1,000 into your IRA, an extra $2,500 into your simple IRA, and an extra $5,500 into your 401k or 403b if you've got a job, or 457 if you've got a job with hospitals, school districts, things like this. By the way, that $5,500 is actually $6,000 for 2015. So let me kind of summarize this retirement issue. What's your plan to retire? Are you buying rentals? All right. Are you doing that? Are you building a base of rental properties? Are you buying stocks and mutual funds? All right. All of these things can be bought with 401ks and IRAs, which is another course altogether. But I just implore you to consider what is your exit strategy and what are you doing with your profits in savings, in investing, so eventually you can retire from this business. Now, a couple of other things, if I may. All right. A lot of you have been scared away by your accountants from the home office deduction. And I'm here to tell you that as of January 1st of 2013, the IRS totally changed the rules on claiming a home office deduction and specifically took away the so-called red flag nature of the home office deduction. Now understand this. The real reason that IRS never liked the home office deduction, now visualize this, right? is the minute you back out of your driveway, you're no longer commuting. You're on the government clock for claiming the business use of your vehicle. That's why they've never liked this. All right? Under the new safe harbor, not only do you get that additional mileage, but you get a pretty significant deduction for the business use of your home. Now, the only problem is this, and I want you to take a look at the slide with me if you would. The first bullet. You must be able to prove that you're using that home office exclusively for the business of real estate. So what you've got to do is you need to have a separate room set up for this. And in my own situation, I have a bedroom that when my wife and I built the house about 16 years ago, we had the contractors basically build an office on that wing of the house right next to our bedroom. And it is exclusively used in my business of providing tax seminars and financial planning seminars. The closets have file cabinets in them. There is no private furniture in them. In fact, when we had the house built, I had custom furniture built in, like the pedestal, table, everyone, and the furniture mounted to the walls and things like this, you know, cabinets and shelves and things like this. So this is something that your accountants may still feel is a red flag, and I'm here to tell you everything changed, excuse me, everything changed as of January 1st of 2013. Now again, take a look at the slide if you would please. If you look at the second bullet, what you've got to be able to prove to the IRS, if you get challenged on this in an audit, you've got to be able to prove that you spend more time running your business, for example, of real estate, from your home office and nowhere else. So you've got to do the administrative and management tasks of running the business from your home office and not from your broker's office. And I'm not telling you you get this deduction automatically. If you are running your business administratively and management-wise from your broker's office, and that's where you spend most of the time doing the administrative and management tasks, then forget the home office deduction. But everyone, so many of you are really doing that from that home office, and you're the ones that you should not be missing this deduction. One more comment about the home office. A lot of accountants don't like it because, and some of you have heard this, when you sell the house, you've got to recapture some of the depreciation. Not anymore. Under this new rule, the way you calculate the deduction does not include depreciation, so there is no recapture when you sell the house. And that ought to take an objection from your accountant out of the picture. Now, in addition to all of this, everyone, all right, the old method of the home office and the new method are still able to be claimed. I recommend you look at the new method unless you live in a very, very, very expensive home and you're using a lot of square footage for the home office. In that case, maybe you don't want to use the safe harbor. Maybe you want to go back to the old method, which is still very much allowable. Now, in the last year, I've been trying to alert self-employed people all over the country about what you see on this slide. 1099 filing requirements. Every one of you knows that you get a 1099 miscellaneous from your sponsoring broker. Well, here's what you don't know. What you all need to do is you need to go through your check disbursement ledger for 2014, and you need to determine whether you paid anyone who performed services for you in the trade or business of real estate, for example, photographers, virtual tour people, maintenance people, repair people. If you paid anyone who is not a corporation, you are required to give them a 1099 by January 31st of the following year, which would have been January 31st of 2015 for 14. And if the IRS catches you not doing this, then the penalties are starting to climb higher and higher and higher. So here's what you need to do, all right? What you need to do is you need to ask your people that you think you're going to be paying money to during the year, before you give them their first check, you ask them to fill out a Form W-9, which you can download from irs.gov on many websites. All right? It's a one-page form, doesn't take 5 minutes to fill out, and they will give you their name, address, social security number, or federal ID number, and you'll use that information so that by January 31st of the following year, you know where to send the 1099 to. So the W-9 is where you get the information from them, so you can then do a 1099 miscellaneous. Now, the last thing I want to talk about, and I'll revisit some of these things also, but I implore you not to put off your taxes till the last minute. What you've got to do, everyone, is take this webinar, all right, and start thinking about your tax return for 2014. And first of all, just a review, I want you to request your accountant to give you an organizer. Start working on that. And here's what happens so many times, and I've been guilty of this over the years, although I've cured myself of this in the last 5 or 10 years. If you give yourself enough time to get your things together and think through the process, you're going to have more things, more dollar amounts that you didn't forget, so that when you do want to claim those things as deductions, by your own haste, you didn't omit something. Another thing, you then need to take your list of deductions and the organizer to the accountant. And just don't drop it off. I think I might have said this earlier. Make sure that your client, your accountant, interviews you, and if you've got any questions about anything you might have missed or anything you're not certain of, make sure you have a 15, 20, or 30-minute conversation with that accountant before you leave your tax records there. In my own situation, I can tell you it takes about a week for me to get everything together to do my corporate return, my wife's corporation return, our 1040, some rental properties that we've got. And I just know from experience that if I try to rush through that, I will miss deductions, and then you've got to go through the hassle of filing an amended return if you either have made a mistake and over-reported your tax or under-reported your tax, and those things can be red flags. So I encourage you, as a last point, do not wait until the last minute. So I'd like to offer up, if you have any questions, I'd like to consider those questions now. We have several minutes before we are done. So if I have any questions, please, let's have them. All right, a question I've got is, and this came in from about 5 of you, all right, is should you incorporate or not? All right? And this is something that you really want to talk to your accountant about. And I will tell you this, and I focus on this in many of my seminars with Kaplan. The S Corporation, the subchapter S Corporation, is probably one of the most common techniques that self-employed people use to reduce their tax liability. And it is the second most used form of doing business. Most of you have chosen to file as sole proprietorships. In fact, 67% of all self-employed people file sole proprietorships. And then the next most commonly used is the S Corporation, followed by the LLC, the limited liability company, followed by the C Corporation. And my point to you is, if you're making good money and you're still a sole proprietorship, I believe you should be talking to your accountant after the tax season and find out whether they concur or don't concur as to whether you should change your business to that of an S corporation. It is a way in which you can legitimately save maybe $3,000 or $4,000 in Social Security taxes every year. And it is something that has been used by self-employed people every bit of the last 30 years. And I've been an S corporation myself since 1991. Another question that I have, and then again, several of you have asked this question, is why does the IRS allow these big deductions on these vehicles like the SUVs and the pickup trucks? And the answer to that is simple. It's just a matter of dollars, all right? those vehicles, the heavy SUVs and the pickup trucks, are the highest profit engines of the automakers. So it's about jobs. It's about giving tax incentives to give people the idea that if they buy that vehicle, they're going to save taxes, which they do, but it also creates jobs for the manufacturers of the vehicles, and it's all one big vicious circle going around and around. Listen, I want to thank you, everybody. I've enjoyed doing this webinar for you. I hope I've answered some of your questions. Again, I only wanted to do this from a concept standpoint, so I want you to talk to your accountant about anything that I've discussed, and good luck with your taxes and make a lot of money, and thank you very much.